It's not a coincidence that a few months after Taxman charted, the Beatles incorporated Apple Records. And they then entered into transactions with Apple Records, which meant that instead of receiving their royalties as income, they converted them into capital. And a special tax rule was introduced to stop people doing that. It was called the Beatles Clause at the time, bits of which are still there, all because the Beatles converted their royalty income into capital gain.
Hello and welcome to the IFS Zooms In. I'm Paul Johnson, Director of the Institute for Fiscal Studies. But before we begin this edition, I want to let you know about the first ever live edition of the IFS Zooms In. It will happen on the 23rd of October in the evening at the British Library in London. We'll be looking at how the Chancellor can make her first budget a success very timely, just 1 week before that first Labour budget. It's free to attend, but spaces are limited and filling fast. So to secure your place now, try heading to www.ifs.org.uk/events and do register, or follow the link in the episode description. Now, on with this show. There's been lots of speculation, and we're talking about the budget again, about tax, of course, and in particular that Chancellor Rachel Reeves is looking to raise capital gains tax in this budget. And this podcast is going to be all about capital gains tax, which is, for those of us interested in tax, quite an exciting little tax. We're going to refer to it as CGT rather than capital gains tax all the way through. It's quite a small tax. It raises about £15 billion a year, which isn't nothing, but it's only 2% or so of total tax revenue. So it's not huge, but as we'll see, it is actually really rather important. It's also not huge in terms of who pays it. In any 1 year, much less than 1% of the adult population pay any capital gains tax. But it is important, both in terms of fairness, but also in terms of making the overall tax system work and making it at all efficient. So there's lots of speculation about whether Rachel Reeves will increase capital gains tax, but the real problem is that it's currently, here's a surprise, it's a tax that's flawed. It's really badly flawed, and it leads to a range of problems. So in this episode, we'll explore why CGT reform is necessary and how changes could make the tax system fairer, more efficient, and better aligned with long-term economic growth. We'll also ask what Rachel Reeves would need to do if she wanted to raise significant additional revenue from this particular tax. To explore that, I'm once again joined by IFS Deputy Director Helen Miller, and again by Dan Neidle, tax lawyer and founder of Tax Policy Associates. Welcome to you both. So let's start with the easy bit. What is capital gains tax? What's it paid on? How much does it raise?
So capital gains tax is a tax on the rise in the value of assets. Very broadly speaking, in most cases you can think of this as the sale price of an asset minus the purchase price. So, you buy some shares for £500, you sell them in a few years for £700, and you've got a £200 capital gain to be taxed. So that's the broad idea. But worth noting that not all assets are taxed. Most notably, main homes aren't taxed. So if you want a sort of an asset in your head throughout this conversation, you should be thinking of private businesses. So businesses that are not listed on stock markets, that's about half of taxable gains. Listed shares, but not those held in ISAs or pensions because they're not subject to capital gains tax. Or homes that aren't first homes, so rental homes or second homes. There's also what's called uplift at death, which I'm sure we'll come back to because it's a horrid little part of the tax, which basically means if you die with unrealised capital gains, those are forgiven for tax purposes. There's no tax on death. You mentioned it's not paid by very many people. So about 300,000 people pay capital gains tax in any 1 year. That's 0.065% of the adult population, so not very many at all. And actually, even among those people, taxable gains and revenues are very highly concentrated. So just 12,000 people, so that's 0.02% of the adult population, pay 2/3 of capital gains tax revenue. So most of the revenue, most of the £15 billion that you mentioned up front, is coming from a very, very small group of people. And mostly those people are already in the top 1% of the income distribution. So they have enough income every year to get them in the top 1%, and then they're getting really very large gains.
So millions of pounds worth of gains to be paying that much tax.
Yeah, so the average gain among these 12,000 people who are paying 2/3, the average gain is £4 million.
Whoa, so these are proper rich.
Yeah. Now, worth saying that capital gains are lumpy. So most people aren't getting that kind of gain every year.
But once would do me.
You might, yeah, exactly. Me too. You might have a business, and then you might, when you finally retire or sell your business, get a large gain. But there are some people, including those who are working in private equity, who are getting gains very, very regularly. But most people are getting, one-off big gains, but they are big.
So just to summarise that, about 350,000 people a year pay some capital gains tax, but of those, just 12,000 are paying 2/3 of that 15 billion, and they've got those 12,000 got average gains of 4 million quid each.
Yep.
So serious amounts of money there. The last thing it's worth saying is, I think it's fair to say that whilst capital gains tax isn't huge, it's significantly bigger revenue than it was 20 years ago.
It is, yes. Revenue and gains and revenue have both been going up for the last 25 years, partly because wealth has become more important in the UK economy. So, yeah, it's still small, but it's gone from under 1% of revenue to closer to 2% of revenue. So still small, but definitely growing.
So, Dan, what's your view of why we've got this tax and how effective it is?
So my lawyer's view is that probably the main reason we have capital gains tax is because otherwise people will take something that is income, convert it into a capital gain, and have no tax. And that's what used to happen. People often look at the high rates of tax we had in the 40s, 50s, in the 90s, 98% in some cases, and say, look how much tax the rich paid then. But they didn't. Because in the 40s and 50s, there was no capital gains tax. So if you were very wealthy, you didn't pay 98% tax on your income. You converted it to capital and paid nothing. It was in 1962 that the Conservatives, actually Anthony Barber, introduced a speculative gains tax, which was like a proto-capital gains tax. And then it became a proper capital gains tax under Labour, I think in 1965. But it was always there to stop the very wealthy manipulating their income into a capital gain.
So I've heard that phrase so many times before and used it myself. You convert income into capital gains. I mean, what does that mean? How would you do that?
How do you do that? Okay, so I receive journalism income on which I pay income tax. What if instead I set up Dan Neidle Limited, which earns the journalism income? I then make sure that I don't actually pay myself any money from the company, but after a while I sell the company to someone else. Therefore, instead of getting dividends from the company, which would be subject to tax as income, I'm getting a capital gain. Or even I mean, it's more difficult now than it used to be, but possibly I don't even need to sell the company. I can have shares cancelled or repurchased, and so extract a capital gain rather than dividend from my own shares. This kind of play has a long history. The Beatles song Taxman was famously complaining, I think about I can't remember the lyric, about a 95% tax because it was 19 for you and 1 for me. And it's not a coincidence that a few months after Taxman charted, the Beatles incorporated Apple Records. And they then entered into transactions with Apple Records, which meant that instead of receiving their royalties as income, they converted them into capital. And a special tax rule was introduced to stop people doing that. It was called the Beatles Clause at the time. Officially, it's the Transactions and Securities Rules, bits of which are still there, all because the Beatles converted their royalty income into capital gain.
But it's also maybe worth saying that in some ways this sounds very complicated. I mean, a lot of people running companies will be doing this very straightforwardly. And you could run a company if you're doing anything. I mean, you could be a plumber or an IT consultant, or you could be running a manufacturing business. And rather than pay yourself in a salary or in dividends, you could leave money in your company. And then when you retire, for example, just take it out of your company at that point, and it'll be a capital gain. And obviously, not everyone can keep all of the money in companies. You might need to actually take some money out to buy your food and pay your rent. But you can do that. And it definitely happens. We've been doing lots of work with the HMRC tax records. And you see people doing this all the time. They are keeping lots and lots of money in their companies in order to access capital gains tax. What we haven't mentioned yet is that capital gains are taxed more lightly than income. So the reason you've got this incentive is because if you take your income in capital gains, you pay a much lower capital gains tax bill. But it's also worth saying it happens in other cases too. So think about what capital gains represent. Imagine I've bought a house. I might just buy a house, get lucky, if I'm a second home or a rental property, it rises in value, I get a capital gain. Or I might buy a doer-upper, and I do it up, I put a huge amount of labour effort into doing that house. I renovate the house, I decorate it myself, I fix it, then I sell it, I get a capital gain. part of the capital gain is the return on my efforts, right? So capital gains can reflect just I've put some money into an asset, I've saved it, I've just got a normal return on that. Or it can reflect other things, including labour, whether that be I work for my own company and leave my money in the company, or I renovate a house or something like that. So capital gains aren't always just the return on capital.
I think I find it helpful to think of three types of capital gains. You've got one where someone is passively investing. I buy some shares. You've got another where someone is an entrepreneur, or otherwise they're, as Helen says, they're putting their labour into the business. Then you've got a third category where there isn't really a separate business, but someone is just artificially converting their income to capital.
It does seem odd at first sight that at least some of those things that you described are taxed at less than my labour income. So if I work at the IFS or wherever, I pay tax on my earnings. Indeed, if I'm a builder and I go out and work for a company, I pay tax on my earnings. Or if I'm a builder and I'm working on a house that I bought, I do it up, and then I sell the house, I'm paying tax at a much lower rate because I'm paying tax at a capital gains rather than income tax rate. And equally, if I'm self-employed effectively, putting money into my company, you pay that as capital gains tax rather than income tax. And again, it seems extraordinary that the two should be taxed at a different rate. But it's not mad that they're taxed at a different rate. There are other reasons for thinking you might want to tax at least some kinds of capital gains less than income. So let's get on to that, because that, I think, then starts to get us into some of the difficulties here. Because everything we said so far, you might think was easy. We just move capital gains tax rates up to income tax rates and just leave it at that. But it's not quite that easy, is it?
No. The complication comes from the point you said about different types of capital gains. So this is slightly nerdy, but sort of hang with me, because I think this is key to understanding what's going on. So part of what people are doing when they're buying assets, whether they're buying a second home or shares or investing in their own business even, is partly you're just delaying the point at which you're going to spend that money. So rather than spend it today, you make an investment and you spend it tomorrow. And you'll get what I'm going to call a normal rate of return on that investment. That's just the amount of money that you're going to need to convince you to make that investment. So say that I need 4.5% to make me put money into my business. And if tax means that I was going to get 5, but now I get 4, I'm going to stop doing that investment. So for these normal rates of return that are just, what investors need to be indifferent between spending their money today and spending their money tomorrow, if those are taxed, you have big problems. And it's not just that you discourage investment, you also discourage investment to different degrees. So if all capital gains were just normal rates of return, it was just people putting money in a bank, getting a normal rate of return, just delaying their spending, then I actually would say, let's not tax them at all. Let's just take it all out of tax. But they're not just that, as we've said. They're also partly the returns to labour, for example. And we absolutely want to tax that, because you're right, it's absolutely bizarre that we have, in addition, the top rate of income tax is 45p. It's over 50p in a pound once you include employer national insurance contributions. But business owners have access to a 10% preferential capital gains tax rate called business asset disposal relief. So there's huge differences there. And I think the problem we've got ourselves into, big picture in the design of capital gains tax, is that policymakers in the UK and elsewhere are trying to use the rates to do two different things. They're trying to not discourage saving and investment, and they think, okay, I need a low rate for that because I don't want to distort where people spend their money, and that's good. But then they want a high rate because they think, it's really unfair and inefficient that I'm taxing labour income less if it's being disguised as capital gains. And there's this horrible trade-off back and forth. And you see over time the capital gains rate going up and down as policymakers pick different points on that trade-off. And I think the key to understand is that you can't use the rate to do all of those things. What we need to do is fix the tax base.
What do you mean by a tax base?
The definition of what is taxed. So at the moment, you sell an asset and it's the price you got for the sale minus the initial purchase price. So that minus the initial purchase price is part of the tax base. It's part of what defines what actually gets taxed. And what I'm saying is you need to give more generous deductions for the amount of money you invested in order to remove the distortions, and then put up higher rates. But this boils down to what I'm saying, you want to tax different types of returns differently. So if it's just a normal return, don't tax it. If it's a return that reflects disguised labour income or returns to effort or market power or something else, then we should tax it. But if we're trying to use the one rate to do everything, we can't do everything. We're going to have a horrible trade-off and achieve not very much.
And everyone else is muddled too. If you look at capital gains rates across the world and compare them with income tax rates, you see there is a gulf everywhere. The only exceptions in the OECD are Chile and Mexico, where the rate is the same, and Estonia, where for reasons I don't entirely understand, the income rate is lower than the capital gains rate.
And Dan, you've worked in the real world, as it were, of seeing people paying tax and trying to reduce their tax liabilities. Is this something that is genuinely used a lot as a way of artificially reducing tax burdens?
Well, artificially, you kind of haven't been able to do in recent times because of anti-avoidance legislation and the attitude of the courts. But people often have a choice, and that choice often doesn't involve complexity. An example, let's say I'm going to buy some shares and I can choose to buy a portfolio of shares which is going to give me dividends, so it's going to yield income. Or I can choose to buy a portfolio which targets growth. My return on the dividend shares is going to be taxed at top margin rate of 39.35%. The return on the growthy shares is going to be taxed at 20%. Now, of course, I'm going to be influenced by that. It would be bizarre if I wasn't. And in any commercial transaction, you will often have choices like that. People looking at the after-tax return, and one of the factors for them will be capital gains versus income taxation. So it doesn't involve, these days, often artificiality. It's just people's incentives being shaped by a difference in rates.
And worth remembering, like I said at the top, half of taxable gains are in private businesses. So a lot of what we're talking about here is individuals running their own businesses, their own companies. And in that case, you haven't got to do anything artificial at all. You earn some money in your company, and it could be because you've bought an amazing machine, I don't know, a fancy computer or something that creates widgets, and you've worked for that company, and you've created some profit. And the return is a mix of return on your capital and your labour, and you've paid yourself some dividends to pay your rent and whatever else, but you've just left the rest of the money in your company. And when you retire, you take it out of your company. So it's not that it's necessarily artificial, it's just that the tax system gives you a huge incentive to do that. And we know from looking at the data, I mean, we've done lots of work here at IFS using HMRC tax records and looking at all business owners, and you can see that they do this. Obviously they do this. Why wouldn't they do this? They retain really large sums of money in their companies in order to get access to these lower capital gains tax rates. And what that means is that partly it costs the tax authorities money because they're paying less tax than they would if they were taking it in dividends. It also means that it's distorting their choices. So some of these people might be happier spending their money today. They don't want to necessarily keep it in their company for the next 25 years, but they do so because they get access to the lower rates. We went through lots of the weeds earlier. I think an example might help here. So imagine I'm going to start a company. I'm going to quit IFS. I'm going to start a company. I'm going to bake cakes or something. And I'm going to put some money in my company to buy a nice oven and some cake baking equipment. And I put £1,000 into my company. And up front, I'm not getting any relief on that. That's coming out of taxed income. And then I have a really successful business. I make a ton of money. And when I retire, I take money out of that company and I get a lower rate of capital gains tax, lower than I would have done if I'd taken earnings out of that company. So partly I'm getting lower tax on my labour income, on my I was the one baking the cakes and doing the investments. And what I'm suggesting a better system would look like is that when I put my £1,000 in the business, I get upfront tax relief. And therefore I'm not discouraging investment. Then at the point I get my returns, then I get taxed the full labour income tax rates. That would be a way of still being able to tax labour income, but not discouraging investment. And there are other ways you can achieve that goal. But what I'm suggesting is rather than have a relief on the way out on high returns, move the relief to investment. So if you're putting money into a house or a business or shares or a painting or something, you get relief linked to how much money you've actually put into an asset. But then when you get taxed on the way out, you just get taxed at normal income tax rates or at higher rates. You don't get relief or special rates on the way out.
And this isn't some science fiction proposal. This is how it used to be. In the 70s and 80s, we had a capital gains tax rate of 30%, an income tax rate that was in the 90s and the 70s and in 60% for most of the 80s. And then Nigel Lawson, in the most tax-cutting budget in British history, reduced the top rate of income tax to 40%. But actually, at the same time, he increased capital gains tax rate from 30% to 40%, matching income tax. But he introduced an allowance for inflation called indexation allowance. So if you bought an asset for 100 and sold it years later for 200, but actually all of that 100 increase in value was inflation, you wouldn't pay capital gains tax. It was abolished because people whined that it was complicated, and maybe some politicians thought it was sexier to have a low rate. But in the modern world where everyone enters their tax return on a computer, almost everyone, This stuff isn't complicated at all. You can easily adjust the original purchase price for inflation.
Yeah, that really doesn't sound hard at all. Can I just check one thing to make sure I've understood this, Dan? So if Helen sets up her company, maybe she doesn't even bake cakes, maybe she doesn't buy anything. Maybe she goes off and sets up her company as an economist, and she keeps the money in the company. Can she really just sort of 10 years or 20 years later take everything that's still in the company as a capital gain and pay business asset disposal relief on it?
If she's selling it to a third party, yeah.
But only if she's selling it to a third party?
If she's not, the rules around repurchasing shares are highly complicated. It used to be pretty easy to manufacture a capital gain for yourself. Now it isn't. Possibly also when you wind the company up, if that's what you do. But again, the rules are complicated, and your podcast listenership is going to drop by about 90% if I go into it.
But I'm pretty sure I'm right in saying, because I know that Paul's asked me this question.
It just seems extraordinary.
I'm pretty right. I mean, I'm pretty sure I'm right in saying, Dan, that if imagine I have got my company and I'm winding it up, I can get business asset disposal relief on that. I mean, there are some rules, but for most people, it's not particularly complicated to get capital gains from a company that you're winding up.
That's correct. We should, however, talk a bit about business asset disposal relief and why we have a relief whose initials spell bad.
Yeah.
Let's do that. So it's worth it. Dan has given us a little bit of history, which is in the 1980s. Nigel Lawson actually introduced a reasonable version of capital gains tax, which essentially aimed to tax you only on the real return. Now, we'd like to tax you only on the amount above a normal return, so it might give you an allowance for a bit more than inflation, but we had an allowance for inflation and taxed at the marginal income tax rate of the individual concerned. Then that got absolutely messed around with horrendously by Gordon Brown in the late 1990s, who introduced much lower rates of capital gains tax for assets that have been held for a little while. I mean, that only meant 1 or 2 years, much lower rates. They were the result that people in private equity were able to claim that they were paying lower tax rates than their cleaners because they were paying capital gains tax rates rather than income tax rates. Alistair Darling then tried to increase the rates of capital gains tax, but there was a huge outcry about this from those who were losing, and as part of that, therefore, he introduced this thing called entrepreneurs' relief, which allowed you to pay tax at just 10%, and the generosity of that was, I think, increased by George Osborne, so that you could actually pay 10% on gains of up to £10 million in your business. That's more recently been reduced, I think, by Rishi Sunak to £1 million. And in the process, he changed its name from the rather cuddly-sounding entrepreneurs relief to the rather less attractive-sounding business asset disposal, or BAD relief. I think that was a perfectly deliberate acronym, because it's clearly something that he didn't think was a good idea. But there might be people listening to this, Helen, Dan, who think, well, look, what are you on about? Look, if you're an entrepreneur, you've put your life and soul into a business, you've taken risk. If you're not going to offer some kind of tax relief for that and charge a lower rate of tax, then you're going to destroy small business and entrepreneurialism across the country. I mean, that, broadly speaking, was the argument that was put to Alistair Darling back in the late 2000s, and why he backed down and introduced entrepreneurs relief in the end. Is there any value in that argument at all?
So I think it's definitely what people are going to be shouting at. People shout that at me every time I talk about capital gains tax. Is what people shout at me about. So I'm sure there are listeners who are shouting at us. I think there's a few things to say. So there might be reasons that the government want to actively encourage entrepreneurship. You might think that without active encouragement, we might not have enough new business and enough new ideas. So there might be a principled case for it. But entrepreneurs relief, and what is now bad relief, which I'll say in passing is my favourite piece of policy making for the last decade, which probably is also a bad reflection on other policy making, but it's just not a good way to do it. So bad relief just applies very, very broadly to anybody, basically, who's running a company or a business and who can take income in the form of capital gains. So it's not just targeting entrepreneurs, it's targeting anybody, including people who are doing perfectly respectable things but aren't particularly entrepreneurial, who, they don't need an incentive to make them do what they're doing. It's also kind of coming at the wrong point in time. So it's the biggest benefit to those who've got really big gains, who've been really successful, who've made a really big profit, then they're getting the biggest tax benefit. But they're the kind of ideas and investments that would have happened anyway. If you've got a great idea and it's going to make you a great profit, it's going to go ahead. Actually, where the tax is going to matter, where tax is going to stop something happening, it's more on the margin, where you've got an idea, it may or may not happen. That's where tax is going to matter. So again, I think we should think about reorienting relief away from give relief to people who've got really rich and got big gains towards people who are making investments and link the relief to the investment.
Everyone involved in bad relief knew that it was a bad idea. And it's a tragic joke that the acronym was not just proposed by the people who designed it, but that none of the politicians looked at that and thought, hang on, either this is a good tax, maybe we should change the name, or what are we doing here?
And what do you understand about the political economy of all this then, Dan? I mean, it seems extraordinary that we had this 10% tax, which was available for £10 million worth of, sounding like Austin Powers here, of gains. And Rishi Sunak didn't quite feel able to get rid of it altogether. He still had to leave £1 million available at 10%. What's going on here?
It was such a juicy target, that 10 million. It was absolutely being exploited by private equity firms who weren't supposed to use it. And that is now, at least in principle, can't be done. But the 1 million is being exploited by others. It's just too low a rate for people to be able to resist taking advantage of. So I don't think it should exist. I've known a great many entrepreneurs. I don't know any when they started out were influenced by capital gains tax rules or even really understood them in most cases. And if you look around the world, there are plenty of countries with as good or more impressive entrepreneurial records than the UK, places like Germany, which have higher rates of capital gains tax. So despite all the special pleading, I'm extremely unpersuaded that we cannot touch this. It's too dangerous for entrepreneurs.
I think there's 2 or 3 very specific issues which are really important here, which we should get onto as well. Dan, carried interest. This is quite important, and it's one of the things that Labour said that they're probably going to do, which is to change the taxation of carried interest, which, as I understand it, is something that private equity people can do, and that means that they effectively pay capital gains tax on something that looks remarkably like their income. That is about as far as I understand it. So, Dan, take it away.
Okay, let's say I'm a banker receiving a bonus of £1 million. Obviously, I pay tax on that. Actually, it's not so obvious because back in the day, all kinds of schemes were involving gold wafers, platinum, you name it, to avoid that. These days, you kind of can't. So a banker receiving a £1 million bonus, the bank pays 30.8% employer national insurance on the bonus pool, and then the banker pays 45% income tax and 2% national insurance. What about a hedge fund manager? Hedge fund manager is probably remunerated with some kind of performance-linked bonus linked to the performance of the fund. Again, there will be national insurance, there will be income tax at a top rate of 45%. Private equity is different. So if I'm a private equity manager, I, most of the time, buy a special interest in the fund that I'm managing. It's special because I pay either nothing or almost nothing for it.
That's pretty special.
It's pretty special. But if the fund doesn't perform, I get nothing. If the fund gets a certain level of performance, called a hurdle, then everything past the hurdle, the management team shares 20% of the return. So the hurdle might be 10% a year. It varies between different types of funds. So if the fund performs extraordinarily well, and there's a large amount of money, a large amount of returns past that hurdle, the management team, despite not putting any money in, get a very large amount out, and that's called carried interest. And if you're a successful, mature fund that's been going for years and making lots of investments, then it may be that every year there'll be a certain amount of additional returns paid, and the managers will get more carried interest. So it looks a lot like our banker with his bonus or our hedge fund manager with her performance-linked bonus. But because of a rather peculiar deal struck in 1987 between the private equity industry and the Treasury, it's taxed as capital gains.
So I assume the argument against simply moving it to taxing it as income would be that, well, other countries do it like this, and therefore we're all sod off to New York or something.
Yes. I mean, the in-principle argument for why we should treat private equity differently is, I think, non-existent. Why do we want private equity managers to be taxed less than hedge fund managers or bankers or computer programmers or doctors or anyone else? I see no argument of principle. The only argument is, lots of countries have been tricked into have been persuaded by careful lobbying into having similar regimes. So we need to have one too. And of course, they're all being told the same thing. It's kind of true and kind of not true. America, has similar rules, which the Democrats keep saying they're going to change, for some reason never do. But America is not somewhere where people typically go to minimize their tax, because once you've got a green card, you are subject to US tax on your worldwide income for essentially ever, even if you then leave the States. So we need to worry about Americans who live here going back to America, but no one else is going to leave the UK and go to America for tax reasons. They might go to Switzerland, they might go to Singapore, but continental Europe, for a bunch of different tax and regulatory reasons, we're not going to see private equity firms go there.
Just to add to that as well, I think we've got here by accident. I think I agree with Dan on that. I think we should be thinking about, again, the one reason not to just whack up rates is because there is some capital investment involved. So again, to keep saying the same abstract thing I keep saying, you would want to give more relief for any investment made, because it is different, and they have maybe put some capital up sometimes. And if they haven't put any capital up, they shouldn't get a relief on it. And then you'd want to raise rates. And then if you think there's a problem about international mobility of people, we should think about, well, which people and what we're worried about. Because currently we do have bankers taxed at high rates. Well, some of those are internationally mobile as well. We have some other people taxed at high rates. So if we wanted to think about international attractiveness, we'd be thinking about, the regime people have when they first come into the country. How many years can you be here before you pay a certain amount of tax? Or some countries have special regimes for new entrants. So I think there are lots of things you could do. We should think about who is it we're trying to incentivise here, and not let our entire capital gains tax system that's currently broken for everyone in the country, most of whom aren't thinking about moving anywhere, stay in place just because we've got this private equity industry that's currently a bit different for accidental reasons.
One other thing I wanted to talk about, which you mentioned in passing, Helen, which is relief at death, essentially. So one of the more bizarre things about capital gains tax is if you hold on to your capital gain until you die, then everything is relieved. If, as my son said, when I was young, I could buy a house for a £5 note and a packet of Quavers. And if I'd done that and then passed it on to him without selling it in the meantime, if this had been a second property, then even if it was well worth £2 million, there'd be absolutely no capital gains on it. He'll be valued at £2 million. And if he then sold it the next day for £2 million, he would pay no tax.
Yes, basically capital gains are forgiven for tax purposes. So the estate of the person who's died isn't liable for any capital gains tax, and the person who's inheriting it is deemed to have inherited it at the market price at the point at which they get it. So they've got, by definition, in that point, no taxable capital gains. And it's absolutely bizarre, because if you have two people with the same asset on the same gains, and one sells it and gets a tax bill, and then one just drops dead, why is the person who's dropped dead getting to have that asset not taxed? It's just bizarre. So as far as I'm concerned, we should just scrap that. And there are different ways to do it. You could have it so that tax is actually paid at the point somebody dies, so the estate has to pay the capital gains tax. Or in your case, of your son inheriting your second home, he could inherit it, but inherit it with the untaxed capital gains. So he doesn't get to write it off. So at some point when he did sell it, he'd have to pay the untaxed capital gains. But either way, I think it should go. It gives a huge incentive for people, maybe Dan can talk more about this, to basically hang on to assets way beyond the point at which they're productive or they're making them happy, just to get the capital gains. So maybe you'd prefer to sell your artwork or your share portfolio or business or whatever it happens to be earlier in life. But you've got this massive incentive to hold on to it. And that's just going to distort all sorts of things and make basically productivity and happiness lower.
And as you say, Helen, it's not only seems unfair, it potentially leaves lots and lots of assets being held by people for no other reason than if they hold them and leave them at death, there's much, much, much less tax than if they sell them earlier and put them to more productive use, or it's owned by someone who would find more use for it. It really is an unbelievably damaging part of the tax system.
I feel the politics of an upfront capital gains tax charge on death may just be too hard, but carrying the gain over to whoever inherits the asset seems like a pretty obvious thing to do.
I've had some people are shouting at me that, what about inheritance tax? You'd be paying 2 taxes potentially. And I'd be saying, yes, absolutely. Because, if you're going to have inheritance tax at all, it should be in addition to other taxes. So capital gains tax and inheritance tax are just doing 2 different things. They're not substitutes for each other. So it's not the case that you'd want to have a capital gains tax and then not have inheritance tax. You should have a capital gains tax, not forgiven at death. And then if you want an inheritance tax, it should come on top.
Oh, but I would say, actually, there's no double tax here if it's done sensibly. So let's say we go with my preferred route of the capital gains are essentially deferred, and whoever inherits, they're treated as acquiring them for the original price. So the inheritance tax that the estate is due is on the value of the assets, and that value of assets should take into account the fact that they're pregnant with this capital gain. So there is no double tax here, as strict mathematically.
I'd like to be pregnant with a capital gain.
I was going to say, you heard it here first. I don't think I've ever heard that term, pregnant with a capital gain.
Pregnant with a capital gain.
Lawyers and accountants use that all the time.
Well, us economists.
I don't think it was just me.
We need to learn the language. We also sadly need to get some capital gains, but so probably either Helen or I have ever been pregnant with a capital gain.
I suppose I never will be either, sadly.
Let's talk about one last thing which really matters in capital gains tax. Something I learned from only relatively recently, to my shame. I was quite horrified to learn that if you make a big capital gain in the UK and then you move abroad, we don't really try and tax it, Dan.
Yes. If someone was to come to me and say, yes, I've been working in the UK, building this business for 30 years, and now I'd like to sell it, but I don't want to pay capital gains. Can you give me some very complicated structure that's going to be highly risky and going to avoid that tax? The answer is, yeah, it's really easy. Just move to Monaco. Because if you move to Monaco and you don't return to the UK within the next few years, and you sell your asset while you're resident in Monaco, the UK doesn't tax it. It's that simple. And lots of people do it.
Does it have to be Monaco? I mean, could you go somewhere proper?
Well, the problem with going somewhere proper is that they will have capital gains tax themselves. So you probably want to go to a tax haven, and that includes places like Singapore, which do have tax, but don't generally tax your foreign gains. So there's quite a few places you could go. Many of them are more interesting than Monaco, but you wouldn't go to Paris.
I mean, that sounds relatively easy to sort out.
The slight complication is taxing people who are no longer here is a little bit tough. But it's a bit unfair to tax them kind of at the point of exit, because they're not actually selling their company when they're exiting. Who knows, they may never sell it. So what you need to do is have a deferred tax, which applies when they eventually sell. And then you need a way of enforcing that even when they're out of the country. And this can all be done. It's not super complicated. It's not super easy either. Plenty of other countries do it. These exit taxes have been the subject of numerous European court decisions, as whether they contravene the EU freedom of movement and freedom of establishment. And that's, I think, one of the reasons why the UK didn't historically have an exit tax. But one of the beautiful sunny uplands of Brexit is that we can do what we like with exit taxes.
It's a Brexit dividend.
It's a Brexit capital gain.
There's actually, sadly, astonishingly, lots more we could talk about in this podcast. But I think we are going to have to stop at this point. Otherwise, our listeners may well be moving to and fro the country to avoid any more babble about capital gains tax. What I hope, dear listener, you have taken from this is that this is really rather, as well as an important, quite an interesting tax, quite a complicated one to get right. And I suppose what I really take from this is that a lot of the pre-budget discussion about this has been incredibly simplistic and not at all helpful. This is not a place where Rachel Reeves can look and just, let's whack up the rate of capital gains tax and we'll get lots more money. You might not get much more money at all to start with. And secondly, you'll certainly be doing quite a lot of damage to the system. What you can do, though, is make the whole system much, much better by straightforwardly, or perhaps not so straightforwardly, reforming things like business asset disposal relief, giving allowances for investments made, getting rid of this uplift at death, make the system more efficient, make the system more equitable, make the system more growth-friendly, and potentially even get a bit more money out of the system. But that means a reform That does not mean simply increasing rates. And I think that is the most important thing to take from this. And as we run up to the budget in a few weeks' time now, we're recording this in the second week of October, I suppose the thing that worries me most is that we're clearly going to get changes in capital gains tax. At least if we don't, it will be an astonishing letdown given the amount of briefing there's been on it. But actually, the 3 months that the government's been in office to work out the details of this really complicated tax and get it all right is risky. And I hope to goodness that they get any reform that they do right, because if they don't, then Dan's former colleagues will be driving a coach and horses through it really very quickly, I would imagine, in terms of helping people find ways to take advantage of any mistakes, errors or loopholes that have been introduced into this very complicated system.
That's a calumny. That's not what tax lawyers do, and I resent it.
I'm terribly sorry, and I apologise to all tax lawyers listening. But I will end there nevertheless. So thank you, Helen. Thank you, Dan, for another fascinating tax-based, tax-themed podcast, which I hope all of you listening have enjoyed. Please, as ever, do look at our work. We have published, in fact, if you haven't had enough of capital gains tax, we have published on the IFS website as part of our Green Budget this year a phenomenal piece on capital gains tax, which goes into, would you believe, even more detail than we've been into in this podcast on how it works, who pays it, how you should reform it, and indeed how you should reform some of the bits we haven't even mentioned today. You can see that on the IFS website at www.ifs.org.uk. And to further support us, please do consider becoming a member for as little as £10 a month. You can find out more in the episode description. We will see you next time.